Hello guys, welcome back. In this video we are going to actually create a Binance account, a Binance futures account. See what requires is email and a password. My referral ID is there as well, so I'll just click on create account. All right, verify the captcha, then fill in the 6-digit verification code. All right, now we are filling in the code. Account created in a matter of seconds. All right, so we have successfully created an account. Now we are going to transfer funds into the futures wallet. Actually, out to coin margin wallet, futures wallet. Okay, as you can see, there's no fund in the account yet. All right, so I have to transfer funds into the wallet. They also have USD margin wallet, but we're actually concerned with the coin margin wallet. So I need to go to the spot, because I have to make deposit into my spot wallet before transferring. Okay. Okay, so right now we have some Bitcoin in the spot wallet. We're actually going to make some transfer now to the coin margin futures account. All right, so we're going to click on transfer. We are transferring everything. Okay, so that's how to transfer to the coin margin futures wallet. Not really difficult. It's coin margin futures. All right, coin margin futures means the buying or selling of an asset without owning it. So you buy or sell an asset without having ownership of it. Okay, so that's where the term contract trading comes from, because when you buy or sell an asset, you are just opening a contract. Okay, you're just opening a contract. And in coin margin futures in Binance, BTC is used as collateral here. All right, it's BTC that we use as a collateral. So as you can see, there's a coin margin futures interface there. There's the order book, orders happening. You see the types of orders. Now we are going to look at the difference between perpetual swap and quarterly futures. Now in quarterly futures, the trades actually have an expiry date. So when you open positions, they will expire at a certain date. You know, even in the conventional futures trading, when the date has elapsed, your trade will expire. That's what we call delivery date. Okay, that's it for perpetual quarterly futures. I mean to say quarterly futures expire, but perpetual swaps, on the other hand, don't have an expiry date. Okay, we'll be moving to perpetual swaps. Okay, now perpetual swaps do not have expiry dates. You hold trades for longer period of time. That's just the main difference. Quarterly futures expire. Perpetual swaps do not expire. That's it. You could hold trades for months, even years, if you want, in perpetual swap. Now we are going to look at how to trade on Binance futures. Normally, trading on Binance futures is not really really difficult. It's easy for you to trade in Binance futures. And now we're going to also look at the risk involved and the other types in Binance, and profit and loss explanation. Now let's look at some things in the interface. Right now we talk about leverage. Okay, now leverage is the ability for you to open positions, and primarily your account cannot be able to open. So leverage gives you a higher percent power, to say. So Binance offers leverage from 1x to 125x, I could just slide it to the highest. Now you see what the warning I get says: your leverage is high, please manage your risk. Yeah, because over leveraging is bad, and you get liquidated quickly when you use a high leverage. So as a futures trader, whether you're new, experienced, or still amateur trader, you don't actually need to use a high leverage. High leverage trading is really risky. Normally when you use a high leverage, it would give you ability to earn big profits, but as well as big losses too. So using high leverage is not really ideal. Just stick with low leverage and manage the risks well, because trading is super risky. Now let's look at see here, we see margin mode. Okay, now what is cross and isolated mode? Cross margin mode shares your margin balance across all open positions to avoid liquidation. So this is a flexible mode, whereas this is a strict mode. That's the isolated margin. You see, it manages your risks on individual position by restricting the amount of margin allocated. I know that margin is the money that is used to open positions, right? So what we call maintenance margin. And of course, you know that liquidation happens when your margin balance falls below maintenance margin. Yeah, when your margin level falls below maintenance level, that's when you get liquidated. So cross margin spreads the balance across all your open positions, so it's flexible, whereas isolated margin is strict, because each position have a specific amount of margin allocated to it. So that's it. Now we are going to look at the other types in Binance futures. Now before looking at other type, you see here we have the order book. These are trades going on. You see place order, we have the limit order, we have the market order, we have the stop orders. Here we have stop limit, stop market, okay, and trailing stop. Now let's look at the limit order. Limit order is a kind of order you determine your own price and you place the order. Now let's say now Bitcoin is let's say look at the current price, let's say 11,453, and let's say I want to buy at 11,400. okay, I'll just change the price to 11,400, and if I place long, I'm opening a limit order, because my price my trade will not be executed immediately, because price has not gotten to 11,400 yet. So that's it with a limit order. You put in your own price, because you want price to get to, you want market to get to where you want to execute the trade. So that's a limit order. So imagine if Bitcoin is here, you could put a limit order to short from here. So you say, okay, if Bitcoin gets to this point, I will sell. So you can put a limit order, and your order will be in the order book. Now let's go to market order. Now market order is a very fast way of executing trade, because it makes use of the best available market price. So when there's a very high chance that you need to get into the market very quickly, you could use a market order. But bear in mind that in high frequency market movement, price is not guaranteed. The price at which you entered is not guaranteed, but the speed is guaranteed. That's what happens in market orders. You enter with the best available market price. That's it. So let's get to stop limit. Okay, now you see stop limit has what we call trigger price and price. Okay, this is a kind of more complex order type in Binance futures, because it makes use of stop and limit. So you have stop price and the limit, so it's like two orders in one. So what you use the stop price, which is also called trigger price, means the price at which your trade will be executed. Now let's say I want to buy Bitcoin at 11,407, which is my price, my own price, which is a limit price, and I said execute if and only if price gets to, let's say 11,420, right? Now when price gets to 11,420, my order gets executed and my price gets entered into the order book at 11,407. Though my price should not still be executed because my main price, which is 11,407, has not been executed yet, but my price will be in the order book because of my trigger price right here. But when we go to stock market, it still means the same thing. So when you put a trigger price is going to trigger at the best available market price. So imagine if I say, okay, I want this to trigger at 11,400, you enter the short position from here and price push down, and you like, okay, I'm not getting out of the market, I just want to lock some of my profit, should in case price retrace to a certain level get me out. But if price never gets to that level and continues going down, your profit will still be reading. So that's it for trading stops, because you use it to lock in your positions. And let me say this also, you use stop limit or stop market to set in your take profit and your stop loss. You can use them to set your take profit and your stop loss. Now let's talk about profit and loss. Now when you open a position, you would see you would be in profit, you will be in loss. Now we have to look at realized profit and loss, or unrealized profit and loss. Now realized profit and loss is the profit and loss gotten from a completed trade. So once the trade has been completed, it's realized, whereas unrealized profit and loss is the profit and loss gotten from a trade that has not yet been completed. So that's it for opening positions in Binance, looking at the risk involved, other types too in Binance. Now in the next slide, we'll be doing kind of live trading. So in that live trading, we'll be showing you how we open positions and how we put in stop, take profit and stop loss. All right, so we are moving on to the next slide now.